Unless you've been living under a rock, you'll likely have caught some of the recent drama surrounding mortgage rates, the base rate, and the seemingly endless Bank of England updates. But what does it all mean, and how does it all fit together? Whether you're a homeowner or not, it's really helpful to know how interest rates affect mortgages and why people get so antsy around those Bank of England announcements. In this video, I'm going to explain how the base rate affects tracker, standard variable, and fixed rate mortgages in that order. So if you have a standard variable rate mortgage, for example, feel free to skip ahead to that section. Before we get stuck in, it's important to understand what the base rate actually is. So this first section will give you context around that. If you already know this bit, again, feel free to skip straight ahead to the mortgages. When the Bank of England lends money to other banks and financial institutions, it charges them interest. This interest is what's known as the base rate. The base rate then sets the tone for how expensive it is to borrow money in other forms too, like a mortgage, for example. As you'll see, not all mortgage rates are directly linked to the base rate, but typically, rates will often rise and fall in line with the base rate, which is why people can't seem to talk about anything else whenever there's a new rate announcement. Tracker mortgages track the Bank of England base rate. So when the base rate changes, your tracker mortgage will move up and down in direct response to any base rate changes. The reason behind this is because your tracker mortgage is actually calculated by adding whatever the base rate is to a percentage set by your lender. So if the base rate is 3% and your lender sets their rate at 1%, you would pay 4% interest on your tracker mortgage. If the base rate then went up by 0.5%, your tracker mortgage rate would also increase by the same amount to 4.5%. A standard variable rate mortgage is one that will vary throughout the life of your mortgage. See what I did there? Typically, you'll be moved to a standard variable rate mortgage once your fixed rate or tracker mortgage deal ends. They are often the more expensive mortgage option as your lender can adjust the rate at any point during your mortgage term. With a standard variable rate mortgage, if the base rate changes, your mortgage lender can do whatever they want with their rate, including increasing it by the same amount, increasing it by more than the base rate change, or making no change at all. This is because standard variable rates are set by your lender. But while these mortgage rates are calculated independently from the base rate, they are heavily influenced by it. So if the base rate goes up by 0.5%, you'd probably expect to see your standard variable rate go up. A fixed rate mortgage fixes your mortgage at a set rate for a set period of time, usually between 1 and 5 years. It's one of the more popular options as it means you'll be paying consistent monthly mortgage repayments for potentially a long period of time. If you're on a fixed rate mortgage and the base rate changes, nothing will change for you because your rate is fixed. When it comes to calculating fixed rates, things get a little more complicated. So strap in while I run you through what's involved. Let's start with the base rate. While the base rate doesn't have a direct impact on how fixed rates are calculated, it does set the tone for how expensive it is to borrow money, and therefore it can influence where lenders set their rates. The second factor is funding. Banks need funding in order to lend money to other people. There are two main types of funding a bank can use. One is retail funding, which is another way of saying all the money stored in the bank from consumers and small businesses. And the other is wholesale funding, which is money a bank borrows from another bank or financial institution. The amount of funding a bank has will determine how much it can lend and at what rates. Swap rates are the final secret factor that really drive the pricing of fixed rate mortgages. When your lender is borrowing money to be able to lend to you at a fixed rate, they pay the financial institution they're borrowing from a swap rate. This rate is based on how interest rates are likely to move throughout the life of your mortgage term. The swap rate aims to account for any potential movements up or down, which is why your rate can remain fixed. If there's a rise in swap rates, lenders will increase their pricing to maintain their profit margin. If they rise too rapidly, lenders tend to pull products and wait until swap rates have stabilized. This is also why the base rate doesn't have as much of an effect on fixed rate mortgages as you'd expect, because in theory, the swap rate has already accounted for base rate fluctuations. Of course, fluctuations in swap rates only apply if you've yet to secure your fixed rate mortgage. If you already have a fixed rate mortgage, there's nothing to worry about. Your mortgage rate won't change when the base rate changes. I appreciate that was a lot of info and even a little bit of maths. Gross. So if you want to know more about anything covered in this video, visit our Mortgages Hub on finder.com by clicking this link here. Or you could check out the first link under extra resources to see what our panel of experts predict is going to happen with the base rate in the coming months. If you enjoyed this video, give us some love below by liking and subscribing, and hit that bell button so you don't miss out. Thanks for watching.